It's a holiday shortened week here on the closing bell. I got Mark Boyer, Salt and Pepper here live. What's up, Mark?
What's up, Jason? I'm good, bro. How are you?
Doing fantastic. Hey, so we
Yeah.
got some good stuff today. Obviously, a holiday shortened week. We had a good President's Day. So not too much in the news in terms of newsworthy topics to discuss, but I think something that we do want to touch on this week and have a conversation about is just the AI euphoria. We've talked a lot about AI and chip makers, semiconductors, tech service, communication services, tech companies. Is that going to fuel further market rally? So before we get into that, I think it's very interesting, right, Mark? So as of yesterday, we had Nvidia to the moon, right?
Nvidia.
16%.
In this type of market, when you get big moves, it's crazy to see how what we call a climax top, and there's some topping signals that are happening on some of these stocks that I'm saying that I'm not saying that I can't keep going up, but sometimes when they just gap up significantly many days in a row, it gets pretty concerning. And we've talked about this on the I think even last week or maybe a couple of weeks ago, we talked about on the podcast just is this like 99, 2000, 2001? And we said that no, because the stocks today, these particular stocks, this is an industrial kind of revolution, the AI place. And,
Yes.
and these companies like Nvidia, okay, so I mean, think about it. Their total revenue this week got it reported was up 265% from a year ago. Okay, 265% from a year ago. That's like outlandish. I mean, that's incredible, right?
Yep.
I don't even know how a company can like even manage that kind of growth. It's kind of amazing to see what's even happening with Nvidia. But their data center, place they're building, all this AI technology are going into these buildings and all these things, right, to get ready for this next wave. And so it's crazy. So the point is the earnings in these companies are not like they were. There was no earnings back in the .com area.
Right.
They were just all speculative. These are serious companies with solid earnings. And so even at their current prices, some would say they look pretty inexpensive. And even after big moves like they have, when you've grown, when you've grown revenue or revenues 265%, you could it looks like you can hold a pretty big PE ratio. So, but all that to say is that you're always going to get ups and downs, and there's times where people like I get a little concerned when there's a lot of giddiness and you see these types of moves. Again, for short term, it can be times to take profits and kind of get to the sidelines a little bit, especially if you it just makes a lot of sense. But anyway, so that's what's going on. The AI space, I think, is significant, and I know you and I have been talking a lot about that, and we have so on these podcasts as well.
Those are really good points. All stuff that I think investors and just in our duty as fiduciaries, as educators in this space, just being able to kind of decipher what's real and what's not, right? Because there might be a company out there that might have no revenue at this time. That's a future play, right? That's more speculative. So you got to be careful of those. But like you said, Nvidia, Microsoft, even Taiwan Semi, which had some, not red flags, but more geopolitical risk with exposure in Taiwan and the saber rattling of China. Companies like that, like that are starting to kind of get into the AI rally, AMD, Salesforce, companies like that, right? Google. So like you said, these are solid companies with great earnings earnings per share and revenue growth potential, and estimates. I mean, look at back in June. When do you think Nvidia hit $1 trillion in valuation? It was back in June
of last year. What now? We're over 2 or almost
now over 2 as of today. Yeah.
Right. Yeah.
Isn't that crazy? A doubling in less than a year. I mean, so that CEO for Nvidia, he actually came out with saying, like, we're strapped at this point in terms of like supply chain, like supply. They just can't keep up with the demand that's going that crazy. So they're trying to allocate to companies that are ready to use the technology rather than like, oh, we're building the infrastructure to utilize the technology, but we still need your chips to do it. Like they're just trying to figure out who and where these chips are going to go to. So it's quite interesting, but good points there.
Yeah, yeah, it's great. It's crazy, but Nvidia's move. I mean, we talk long term about it, but this move since really January. I mean, it's only been. I mean, it was at $500 in, which is still high, and it had moved up, but it was at. It has some resistance at about 505.
Mm,
Right up until you know January 1. I mean, and
yeah,
then all of a sudden it broke out on the 8th of January, and from 500 520 to now
yeah,
you're looking at just barely today as of this.
mhm,
We're right at just below 800. So I mean, that's a pretty significant move. And there's even other stocks like you said that have done even more. So anyway, it's a unique time. This is a unique kind of rally, and we've talked about this in the past. That this is this is revolutionary. Don't know where it goes long term. There's a lot of
yeah,
concerns about AI. You got to
hmm,
and I think there's a lot of concerns of out of control where that ends up going, because there's a lot of we don't really know,
yep,
and the government's trying to figure out how to get control of it. Even some of the big players, Musk and these different people, right, have talked about,
yeah,
how do we control this whole thing? So I think there's a lot of concern there, but you can't argue with the fact that there's, it's sort of a rebel, it's a new industry that sort of revolutionizes, tech in a new way. So see, there'll be a lot of winners and there'll be a lot of losers. It'll be real important for people, exposed in the growth, these types of names. I just think diversification is really key. And just so our clients, so people know is like, hey, you may not have Nvidia stock in your portfolio or Microsoft or AMD, like
yeah,
specifically that stock. But I know for us, a lot of the portfolio, especially in the growth side, for us, we have them. They
built
are
in,
you
yeah,
do own as an investor
yeah.
more of those companies than you realize, just with good management behind that too. So anyway, make that point as well.
And I think what I'm looking at and concerned about. So, obviously year to date, the major indices are all up here, we've except for small caps. So small caps, lagging behind. We're about half a percentage point down for the year. NASDAQ and S&P up over 6.5 respectively. And the Dow Jones is up almost 4% for the year, right? So, we've been hitting new highs this
Awesome.
year.
Dow and
What's that?
S&P are both hitting new highs. I mean,
Yeah. Yeah.
and we showed that. I mean, that we hit new highs again this week. Some are saying, "Hey, 60,000." Where's the Dow going? So that's been good. I mean, those things. Nasdaq again, part of the tech stock. It's interesting. We hadn't even hit a high from back a couple years ago. Nasdaq is still actually fighting for its high, which let me see, goes back to 16,212, which was in November of 21. So it's been over 2 years. The Nasdaq's actually gotten that. So that's interesting. Tech is the big name. Everybody's talking about tech, but the tech Nasdaq itself has not even hit a new high since in the last couple of years.
So that's what I was saying is my concern, and looking at this rally, especially the AI rally and the euphoria behind it, is okay. So we've talked about narrow market, participation. Is it broadening out? If you look at this rally as of yesterday, both the Nasdaq and the S&P, less than 60% of the stocks in those indexes participated. There was a somewhat muted celebration among those companies in that index. So, as an investor, as an advisor, and a fiduciary to our clients, we're looking at it saying, okay, like, economy's still chugging along, unemployment's low, jobless claims again barely over 200,000 for the week, continuing claims at about 1.8 million. So we're still chugging along resiliently here in the consumer sector, in the worker and the labor sector. So for me, it's like I'd like to see that kind of broaden out still among the indexes. We've got laggards, obviously oil, healthcare, utilities, energy specifically, which is a larger portion of oil, midstream, upstream, different sectors
Yeah,
within oil. But
yeah,
I think, wouldn't you say, you'd like to see it kind of
absolutely.
broaden out from here?
Yeah, I mean, I think a lot of those other areas, you got sort of a specific tech group that's really, running the show right now. But interest rates, where the Fed's doing those things, and we've talked about ad nauseum. But basically, that's what everybody's watching as the overall economy and how
Yeah.
those, how that, how they spread out. So for a healthy market, like you just said, we need to see small caps participate, which they're doing better, and but they're still not in the same, they're not playing the the extreme positive game that some of these
Yeah.
other areas are right now. So that'll be a big deal because really that's the bread. I think small caps and mid caps too. Kind of are the bread and butter of the economy. It's like where
Yeah.
it kind of gives you a view of like the smaller consumer out there, the small businesses, all those things, how they're doing. So that's real important to your point. It's really important to see a broadening now.
And can you talk a little bit? So we've talked about equities. Can you talk a little bit about fixed income? Can you bring up the 10-year yield chart for us here so we can have a discussion? I think it's really key for our listeners and viewers here to understand a little bit more about fixed income. Obviously, they call them boring bonds, right? But
Yeah,
they're very important in a diversified all weather portfolio, especially with the equity risk premium at such small margins at this point in terms of looking at complete indexes. I mean, you could take a lot less risk with fixed income, but get equity like returns over the next few years with where the Fed rate cuts could go. So, can you speak a little bit to that, Mark,
yeah.
and tell us what
So
we were seeing on this chart?
yeah. So this is a chart of the 10-year Treasury yield. So basically, this chart shows interest rates right now in the market. Okay. So and specifically to the 10-year bonds. Okay, so that's a 10-year yield. So it's today's, where that's trading right now is on the 10 years out. So again, remember, if you buy a bond, it's you're not an owner like you are when you buy stocks. When you buy stocks, you're an owner of a company or whatever you're invested in, right? In bonds, you're a loaner. So if you buy bonds or if you invest in bonds, you're actually loaning your money to some entity that's guaranteed to, based on the parameters of that bond. They're going to, par bond is say it's $1,000. You're loaning $1,000 to the U.S. government in a 10-year, and currently they're saying that you're going to get almost 4.3%, where the current yield is. You get a
Mm-hmm.
4.3% yield, annual yield, and then your $1,000 back at the end of 10 years. Does that make sense? Does that, you
Yep.
hear that? Okay.
Mm-hmm.
So that's what's great about bonds. Okay, whether they're, and this is a 10-year. You could be a 30-year. You could have 2-year, 5-year, ten
Yeah.
year, 30-year. You could actually have T-bills that are 3 months. Okay, so they're
Yep.
actually going to guarantee you a specific interest to a future maturity date.
Mm-hmm.
They're guaranteed, okay, unless your risks associated with bonds are always the issuer's risk. So the most supposedly in investing, right? Bonds. The most secure bond is what? What is it?
Treasuries.
Treasuries, right? Is U.S. government, backed by the U.S. government. So
Yep.
we track the U.S. government 10-year yield, or as an example, to kind of get an idea of what those yields are doing. And you'll see this one, again, real important. Let me before I move forward, really important to realize that if you buy a bond and you hold it to maturity, you get that yield, annual yield, until such time as then you get your money back. Any questions on that? Does that make sense?
Makes sense.
Okay. So the question is, then what happens when during the course of that period, how come like my bond, like I bought bond or bond fund and I'm getting, I like the yield on it. It gives me monthly income or quarterly income, whatever. And I like that part, but how come like when I get my statements, do my statements show that I've lost money in the value of the bond? You ever hear that? I've heard that some before, right? So that's kind
Oh
of
yeah.
it's a big question.
Yep.
And here's the answer. The answer is that bonds, there's a massive secondary market for bonds. So as interest rates move on a daily basis, the value of your bond could either be can move up or down based on what interest rates are doing. And it's always, and we talked about this before, but it's just simply there's an inverse relationships to the value of bonds and interest rates. So if this side represents interest rates, okay,
Mhm.
and this side represents, so you buy a bond, par bond, you got, let's just say it's 4% interest rate now, and here's the value of your bond, it's $1,000, right? If the interest rates go down, okay, what happens to this side? Well, the
Prices
price
go
of
up.
your bond actually goes up, okay? Why is that? Well, reason is because in the market, as the interest rate goes down, if you locked in a 4% interest rate on a 10-year T bill, right? And now interest rates go to 3% down, okay? And I'm an investor now in the secondary market looking for income.
Yeah.
Your bond looks really attractive because now bonds are 3% and you're holding a 4% bond. I want your bond,
Yeah.
Jason.
Yep.
But you'll say, okay, well, gosh, why would I sell you my bond if I'm getting 4% and I can only get 3% now? Well, you
Yeah.
might sell it because you're going to sell it to that investor at a premium. So
Yep.
you might get, $1,100 for your $1,000 bond, your $100 more. You know what I'm saying? So you get that,
Yep.
So you get a premium because, and the more that moves, the more that can, the value of your bond go down. What we've seen the last few years as interest rates actually, you'll see in this chart, you see this like from here, you see here, all the way from here to here, we see as it's going up. This is again T-bill or 10-year Treasury bonds have the yield has been going up. So in that case, same scenario, we've had interest rates that started off at 3%. Okay, 3.2 is on the screen is the low, bottom left corner. It's
Yep.
3.2%. And then over the course of that period of time, interest
Up
rates
to
have
5.
gone up. Okay.
Yeah.
So what happened to the bond yields? Bond yields then, okay, have gone down. Well, why is that? Well, because as interest rates gone up, you're holding a bond if you invested at 3%, and now bonds went to 5%. You can see at the top of this market, and you got your bond out in the secondary market. Um, your 3% bond doesn't look very attractive in the current, up here at 5%, correct?
Mhm. Yep.
So you're
Correct.
like, well, dang, I got this. I'm getting 3%. I can get 5% now. That's not great. So what do I do?
Yeah.
Well, you could sell your bond, but your bond, because the interest rates have gone down, the value of your bond actually went down. So you might get 90 cents on a dollar. You might get $900 for your thousand. So
Yep.
you lost money. Now again,
Principal.
you
Yeah.
don't worry about that. You're still getting the income. You still get that 3%, and at the end of your 10-year period, you'll still get your money back if it's held in the portfolio to the length of it. But in the meantime, day to day, it can fluctuate in price. So does that make sense?
Makes complete sense. And the way I like to describe that, what exactly you said to me and to our listeners and viewers here, is I like to describe it as hey, so let's say, especially right now, right? Like Fed's paused, we're waiting for the first cut. At some point this year, we think we'll get the first cut, especially with the most recent Fed meeting minutes that came out here in February. So let's say you're extending duration, you're buying 10-year Treasury notes, or 2 and 5 year, your average duration somewhere in the 3 to 6 year range. And so you're loading more into those intermediate term bond funds or those ETFs that we like to use, because we think active management in this type of environment is really key, especially in the fixed income market, right?
Yeah.
Amen, right, Mark? So
Amen to that. I totally agree. Yeah.
So with that being said, is we're basically early to the party, right? Because we're before rate cuts start happening, which is where you want to be, because that gap between the last rate hike and the first rate cut is the time to kind of add duration to your bond portfolio if you're able to. Again, not for immediate cash needs, but again for just in terms of total return, in terms of taking advantage of where we're at with rates.
Yeah.
You're early to the party, so you're being early, nobody's there. It's not the most fun time to be at a party is before everyone gets there, but you're able to get your food, your drink, and you're able to get satiated and full. And then when people start showing up, all you have to do is enjoy the good time, baby. Get on that
Yeah.
dance floor, start dancing your booty off, and
Great way to go.
and
Yeah.
let the good times roll. So that's the way I like to describe it to clients, is because once those rate cuts start happening, then and you're already holding the type of duration and the type of fixed income that
Yeah.
your portfolio suggests or your advisor suggests, it's good times for the next
So,
few years after that.
yeah, and we've talked about that in some past podcasts too. You see that the 10-year hit a high in October, basically
Mm-hmm.
October of 2023, right at 5%. Okay,
Yep.
and you see now this portion here as we've moved down, we've actually rates started to come down. So why did rates come down in there, Jay? Remember what the news was? You just
The
mentioned it.
Yeah, the rate cuts weren't happening as of yet. Or
Correct.
they were gonna
Yeah.
start though in 2024,
Yeah,
basically. Yeah.
so they basically Powell came out, the Fed came out and said, "Look, we're probably done
Yep.
raising rates anymore." It's kind of funny because if you look at this chart and that peak of interest rates is actually the low of the stock market at the same time, right? So
Mm-hmm. Yep.
again, you got to look at this inversely. And as the bonds actually stocks and bonds from this point actually started to really take off. Why?
Yep.
Because interest rates were coming down. And so we had a point here where interest rates had come down from October down to right here at 3.75 up until right at the end of the year. And then and since then now yields have sort of kind of recovered back to like 4 point. You see this movement in
Yeah.
here. We've kind of come back up, right, in this direction. Kind of, and I wouldn't be surprised to see actually the 10-year go to 4.5. Um, and so again, you're getting your yields as it came down here. The price of those bonds were actually going up, and now bonds again. It depends on you. Just your point. It depends on duration, but you may have lost some principal value in the near term on a fixed income if you bought them down at this lower interest rates. But point is, we really, again, like you said, might be early to the party. And we told it, a lot of people were thinking 7 cuts this year. And
Yeah.
we were not thinking that from the get go. And we're not, we made a point about bonds that we're very positive on bonds, very bullish on bonds, especially like longer term now. But we may not get rate cuts until the end of this year, towards the second half.
Yep.
And if that's the case, then we'll be in this kind of, let's call it a purgatory or whatever. You're still
Limbo.
getting the yield, but again, and to your point, really important to not throw the baby out with the bathwater. You have to have a reason why you have fixed income in your portfolio. Hang in there. The beauty is you have yield now, and you're still getting that. And we think that down the road you're going to get some good price appreciation as well, like you said. So good stuff.
Excellent.
Yeah.
Excellent. Excellent. All right. Well, that's all we had for you this week in the closing bell. Mark and I will be back next week with some more show-stopping entertainment and intriguing news.
Hey, Jason, though, before you leave, what about we opened our newsletter with
That's right.
kind of a new thing. Make sure you cover that as far as
Yes, good.
referral.
Thank you for reminding me. So, Mark and I obviously been talking, and there's been some great opportunity coming forth, and we're actually able to take on a few new households this year. Right? Obviously, we've been super busy. Growth has been exponential this last year and a half or two, but we're ready to take on a few more new families. So, we're offering what's called a second opinion service. So basically how that works is if you like what we do, if you're clients of ours and you appreciate the insight and the relationships, which we value very highly here on our side at Boyer Financial. And I know Mark would echo that sentiment.
For sure.
But we're basically offering a second opinion service to referrals. So let's say, Mark, if you were a client of ours and you had a friend, a family that, had an advisor that maybe, things didn't work out right, or they're looking for a second opinion on their portfolios or their financial plans, we'll give them a free consultation and a free opinion on their portfolios and their plans, and seeing, if that's something that we can help them with. So, if you have anybody, please feel free to reach out to us via email, info@boyerfs.com. You can, comment on our Instagrams or Facebooks, YouTube, social media. There's plenty of ways to get a hold of us. BoyerFS.com as well is our website, and we have a contact form on there. So please, we have a few spots available. We're busy as it is, but would love to help anyone out that needs it.
Absolutely. Love people. Want to help as many people as we can. So, you know what, Jay, we're not great sales. So we're not super salesy. So
Nope.
it's referrals is a big part of our business. So, yeah, if somebody needs help that send them our way. I'd love to at least give them some of our insight and wisdom on that. So, all right, bro.
Absolutely.
Thank you, man. Good
All
stuff.
right. Thanks, Mark. We'll see you next week. Empowering futures, nurturing legacies. That's Boyer Financial. See you next time.